Welcome back. You're watching the Mutual Fund Show and we're having a conversation about fixed income strategy. Joining me, as I said, to talk to you about how you should fine-tune your strategy is Prableen Bajpai as well as Manikaran Singhal. Thank you so much to the both of you for taking the time and speaking to NDTV Profit. I will start with you, Prableen, just to set the context. We've spoken about how fund managers are approaching the bond markets right now, but how should individuals ideally look at fixed income as part of their overall strategy?
Good afternoon, Alex. Great to be on your show. I think fixed income is actually the backbone of any portfolio. And as Indians, I think we all have always loved fixed income products, be it the post office schemes or the bank FDs, your EPFs, public provident fund. And I think debt funds within the fixed income basket are still the underutilized component. But I think they play a very, very important role. And be it different time horizons, be it your near-term goals to medium-term to long-term goals, I think there is some element of fixed income which should be there. And I think debt funds are there available for each of these different horizons. And they bring with them multiple benefits. And I think it's a slightly lesser understood category as well, the overall space of debt funds. And I think at this point in time, like you discussed with Pankaj, I think the long duration funds definitely are looking great. And people with long-term horizons, they have the passive strategies as well available for them within the debt space. So I think that definitely looks good. And there is scope for additional, little returns there as well. As we move towards the interest rate cut cycle going forward.
Fantastic. So we'll talk about tactical allocations as well. But traditionally, and this one's for you, Manikaran, we've looked at fixed income because of the ability to protect capital as a method or a vehicle to achieve shorter term goals. So we don't say invest in equity if you have a goal that is in the next 1.5 to 2 years, right? So you go towards fixed income because you're protecting your capital. Does that still hold true in the mutual fund space, though, considering that the tax laws have changed?
Okay. Hi, Alex. Thank you for having me on your show. Like you said, like Pankaj was discussing that the bond cycle is too complicated to understand. The same way, I would say the investor behavior is again more complicated to understand, more complicated than the bond market. I mean, just because of tax efficiency, we are talking about debt fund, short-term and medium-term kind of usability, but the usability has not changed at all. Even the tax rules has changed for the long-term capital gain tax, but for the short-term, it is still the same. So taxation has not changed, but the usability is definitely looked into. And that mutual fund is still a good tool to build and maintain discipline as far as the medium-term and short-term goals are concerned. Like business accounts definitely make use of the debt mutual funds because in the current account there is no interest they will receive, but in the debt mutual funds, in the short-term mutual fund, they do earn something. It is used for the short-term parking of the fund and for the investment point of view also. Even if you want to average out the market. So the rebalancing of asset allocation from STP point of view, systematic transfer plan, and from the rebalancing of asset allocation, if the market is going good and you want to cut down the equity exposure and be again into the debt fund, into the debt market, it's easy for you to move between the mutual funds rather than moving between the other traditional deposits like fixed deposits or post office schemes. So it is still, it still hold true.
Yeah, and I think what I take from that is also, if you look at fixed income mutual funds versus fixed deposits, that deferment of gains and the deferment, therefore, of the taxation is an important aspect to bear in mind as well, right? But
yes.
Of late, Prableen, this has entered the conversation because of that change in the taxation norms. There has been a conversation about using hybrid strategies that have a significant allocation towards fixed income, but have equity-like taxation because of the construction of their portfolio. Is this the right comparison to make, though? Because you still have a sizable equity exposure in that hybrid fund.
So within the hybrid space, Alex, we have six different kinds of options available to us. And a few of them still have the debt taxation. Some of them will have the debt with indexation taxation. And of course, some of them bring the taxation benefit for equities. So broadly, which particular category are we picking from within the debt space? That is very important because, for example, if we are looking at a person who's been investing in the fixed income and we are looking at an alternative from the hybrid basket, we can't go beyond a small percentage in equities because that would also change the risk profile of that product drastically. So I think it's so important when we're looking at the hybrids, we actually know what is the risk appetite of the investor, the ideal horizon, that has to be known in advance. And then accordingly, I think the right hybrid fund can be picked. But definitely hybrid funds, I think, are a great fit for any investor's portfolio, given the variety that they offer, starting from the arbitrage funds, which are low risk and yet offer the equity benefit from parking point of view, to multi-asset funds, to balanced advantage funds. But again, which subcategory from within this broader hybrid space, I think will depend on individual investors' requirements and his profile.
Okay, fair point. Manikaran, do you want to add to this? Because I think a lot of important points were made there. I've heard it said, and I think rightly so also, that hybrid funds don't remove the need for asset allocation strategy. They don't fix that problem for you. So it needs to fit somewhere in your portfolio. And I think what you said at the start as well makes sense in this argument as well of fixed income, pure fixed income versus hybrid, which is don't make it a decision just because of the tax laws. How do you advise people to go about whether going for hybrid or going for fixed income?
See, Alex, the tax laws has changed not only for the debt funds, but these are for the non-equity category funds, right? So even the gold funds fall into this, the international taxation funds fall into this. So if we try to get into the hybrid category, then we'll definitely lose on the asset allocation part and the diversification part, which has many advantages just if we ignore the tax aspect into it. Simply, if you want to have the tax benefit, you have to add on equity. And the more you add on equity, the more you add on the volatility part of the portfolio. And the investors these days, I would say the investors who's been investing for the last 10 years or 15 years has actually not seen the slowdown yet. And they don't know, they don't understand that what the bear market may bring into their portfolio. They need to understand what risk that equity, definitely equity comes with the growth and it's a long-term portfolio. But everybody, just from the taxation point of view, can't design a portfolio like that. One has to be wary of the risk. And what if the 3-year, 5-year slowdown may come in front of them, and how will the portfolio like and how will they behave at that point in time? What would the status of the goals? Will they achieve that or not? Taxation should be secondary. these asset allocation and the basic financial hygiene should be the primary aspect of designing a portfolio.
Okay, fair point. Prablin, you were talking about the potential for a tactical allocation towards fixed income. And now I think there are a few thumb rules that can help people understand the potential for gains. And I'm saying thumb rule because I'll go back to the original point, which is that this is not a very well understood category. When bond yields fall to a certain extent, there is potential for capital gain. When bond yields rise to a certain extent, there's potential for capital loss. So you don't necessarily always protect your capital in a fixed income fund. How would you explain that, one? And what should you bear in mind in this current scenario when you're talking about bond yields at a certain level and the potential for a cut of 200 to 250 basis points in an interest rate cycle, which can go anywhere between 1 year to 3 years? What is the potential for gain for capital?
Right. Alex, we often say that don't look at the past returns while investing. And I think that is even more important when we are talking about debt funds. So I'll just go back a little. During the COVID period, we saw drastic deductions in the interest rates. And what was happening was that at that time, suddenly the long duration funds, where investors had invested earlier, started looking so good. And we were even looking at double-digit returns at that time. And people really wanted to go and invest. In fact, the inflows had increased in gilt funds, long duration funds, because everybody was chasing those 11, 12, 13% returns, which started to show because of the drastic reduction in the interest rates. So first thing that, never look at the past returns, especially in the debt segment. Now, answering your question about what kind of returns or, return potential can we see. So I think we've been saying this for the last almost a year and a half now, that, we are at a time where globally we've seen the interest rates going higher and higher, and the yields were looking good. So if you were invested and you already, parked your money, and let's say 6 months from now or 3 quarters from now, we see an interest rate cut, that is the time when, depending on what is the duration of the debt fund that you're holding, you will see a positive impact on the NAV. So I'll give you a simple explanation here. There is something called the modified duration of every debt fund. So for a layperson to understand, what they can look at is the modified duration of their scheme. So let's say the modified duration of a particular scheme is 4 years, and we see an interest rate cut by about 1%. That will positively impact the NAV of that scheme by 4%. And the opposite happens if there is an interest rate hike. So for example, if there is a hike by 1%, then there will be an impact, negative 4% on the NAV. So definitely at the point where we are, as on date, interest rates have almost peaked. If we are looking at a deduction going forward, I think it's a good time if investors actually genuinely, there is a need for a long duration debt fund in their portfolios, they can actually look at parking in. I think some of the wonderful passive products are there, which even have maturities of 2028, 2030, 33. That is definitely something they can look at. But if the modified duration of your particular scheme is not too much, let's say it's 6 months or 1 year, then definitely the impact of rise or fall in interest rates is always lesser. And that is why it's advised, when we are looking towards a hike in the interest rates, you park your money in debt funds where the durations are not too long. And at times when you're looking at deductions, that is the time when you should be parking your money in longer duration products. But Alex, ultimately, it must suit the overall, I think, profile and portfolio of the investor, because making tactical calls in the debt space can be a very, very tricky bet as well.
Absolutely, and very well put. Thank you so much for breaking that down. And I will take the liberty of saying that target maturity funds are essentially what you were talking about. And we will talk about various options down the line as well. But Prableen as well as Manikaran, thank you so much for joining in and for speaking to us on NDTV Profit. Viewers, there you have it. That is a conversation about fixed income products and fixed income strategy. You see the number at the bottom of your screen. If you've got specific questions about mutual funds, don't hesitate to send it to us and we'll answer it over the course of the coming week. Do stay tuned. This is NDTV Profit.